When the market crashes, most people panic. Savings shrink. Headlines scream collapse. Experts warn of uncertainty. Families start cutting expenses. Investors rush to sell before things get worse. It feels like the system is breaking. But somewhere, in quiet offices and private boardrooms, something very different is happening. Phones aren't ringing with fear, they're ringing with opportunity. Because while millions are trying to protect what's left, a small group is preparing to buy what's discounted. Recessions don't shock the wealthy, they position for them. And the uncomfortable truth is this: economic crashes don't destroy most fortunes, they transfer them. The real question isn't whether a recession is coming, it's who will be ready when it does. The lie we're told about recessions: every recession is presented to the public as a disaster to survive. Headlines focus on falling markets, rising unemployment, and shrinking growth forecasts. The language is defensive: protect your savings, reduce exposure, avoid risk. For most households, this message translates into caution. Spending slows. Investments are paused. Fear becomes rational. But recessions are not only periods of destruction, they are periods of repricing. When markets fall sharply, what collapses? First is often confidence rather than intrinsic value. Businesses do not instantly lose their productive capacity. Real estate does not vanish. Consumer demand rarely disappears permanently, yet asset prices decline rapidly. Because uncertainty spreads faster than fundamentals change, the public is conditioned to see falling prices as danger. Experienced investors often see distortion. When fear dominates, assets frequently trade below long-term value. That gap between perception and reality creates opportunity. A downturn does not automatically destroy wealth. It exposes who is prepared and who is overextended. Why downturns create billionaires? Economic contractions compress asset prices across nearly every sector. Stocks decline. Private businesses struggle with cash flow. Property markets stall as buyers hesitate and credit tightens. Owners facing pressure are forced to make decisions quickly. Forced decisions create discounts. When revenue falls but obligations remain, many sellers lose bargaining power. Investors who borrowed aggressively may face margin calls. Business owners carrying high debt loads may need to liquidate. Property holders under adjustable loans may be unable to wait for recovery. Those with liquidity operate from a different position. They are not compelled to sell. Instead, they evaluate what becomes available. Strong companies acquire weakened competitors. Investors purchase fundamentally sound assets at valuations that would be impossible during expansion cycles. Real estate portfolios are assembled quietly at reduced prices. Time horizon becomes decisive. Individuals operating month to month cannot always wait for markets to rebound. Wealthy investors structure capital for long-term cycles. They understand that recessions are temporary phases within broader economic growth. When recovery arrives, assets purchased at depressed prices appreciate significantly. Billionaires are not created because downturns are generous. They are created because downturns magnify the difference between forced selling and patient buying. The liquidity advantage. Liquidity determines power during economic stress. Cash and accessible credit provide flexibility when others face constraint. During expansion periods, holding significant reserves may appear inefficient. Fully invested portfolios show higher short-term returns. Yet when contraction arrives, liquidity transforms into leverage. Many households operate with limited margin. Monthly expenses, loans, and obligations reduce flexibility. When income becomes uncertain, selling assets may feel necessary to maintain stability. Unfortunately, those sales often occur at the lowest valuations. Wealthy individuals and institutions prepare differently. They build reserves during strong cycles. They secure lines of credit before markets tighten. Their financial structures allow them to endure volatility without immediate liquidation. Banks also behave asymmetrically, extending favorable terms to strong borrowers, while restricting riskier ones. Private equity firms demonstrate this dynamic clearly. They raise capital during optimism and deploy it during pessimism. Distressed assets become acquisition targets. Entire industries consolidate under stronger ownership during downturns. Transactions occur without headlines, yet they reshape markets permanently. Liquidity turns crisis into opportunity. Without it, downturns feel suffocating. With it, downturns feel strategic. Why panic is so expensive? Human psychology intensifies economic decline. Loss aversion makes falling portfolios emotionally painful. News coverage reinforces worst-case scenarios. Social narratives push urgency, exit before losses grow worse. This pressure drives reactive decisions. Investors sell at market lows to stop discomfort. Entrepreneurs delay expansion. Even when competitors weaken, employees reduce long-term contributions, precisely when assets are discounted. Each action feels protective, yet collectively they limit future upside. Institutional capital operates with a different framework. Professional investors analyze fundamentals rather than headlines. They distinguish between temporary volatility and permanent impairment. When price drops below reasonable value estimates, they accumulate instead of retreating. The cost of panic extends beyond immediate loss. Assets sold during fear are often repurchased later, at higher prices if they are repurchased at all. Emotional selling transfers opportunity to those positioned for patience. Markets reward discipline over reaction. During downturns, patience becomes a competitive advantage. How wealth quietly shifts hands. Recessions restructure ownership across the economy. Small businesses with thin margins close when revenue slows. Larger competitors absorb their market share. Public companies under strain accept acquisition offers below prior peaks. Real estate properties move through foreclosure and into long-term investment portfolios. The assets themselves remain, the owners change. These transitions occur incrementally, a merger here, a distressed sale there, a restructuring agreement negotiated quietly. Yet over time, consolidation strengthens dominant players and reduces fragmentation within industries. When recovery begins, the benefits flow to new owners. Market share expansion increases profitability. Assets acquired at discounts appreciate. Equity accumulated during pessimism grows as confidence returns. Recessions do not eliminate value from the system. They redistribute it from those unable to withstand volatility to those prepared for it. Economic cycles test balance sheets and patience simultaneously. Fragile structures contract. Resilient structures expand. The pattern repeats across generations. Wealth does not disappear in a downturn. It moves methodically, strategically, and often permanently. The real advantage no one talks about. The biggest advantage the wealthy have during a recession isn't just money, it's control over timing. Most people are forced to react. They sell because they have to. They cut investments because they need stability. They make short-term decisions under long-term pressure. The wealthy rarely operate under that pressure. They don't rush. They wait. They understand that markets move in cycles. They know panic creates discounts. And most importantly, they aren't forced into emotional decisions. Control over timing means control over outcome. When you don't need to sell, you gain power. When you can choose when to buy, you gain leverage. When you can wait longer than everyone else, you usually win. Recessions don't just test wealth. They test who has the freedom to decide and who is being forced to survive. And freedom in timing is often the most valuable asset of all. The next recession isn't a matter of if, it's a matter of when. When it comes, markets will fall, fear will rise, experts will argue, and millions will focus on damage control. But behind the noise, something quieter will happen. Money will move. Ownership will shift. Assets will change hands. Not loudly, not dramatically, but decisively. And years later, when recovery feels normal. Again, very few will remember the exact moment the transfer happened, because wealth rarely moves during celebration. It moves during uncertainty. The only real question is this: when the cycle turns again, will you be reacting to fear, or will you be ready for opportunity?